So this is the last session of financial management. So let's understand the meaning of dividend. A term dividend refers to the portion of a profit which is distributed among the owners shareholders of the firm. So dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, it is able to pay a proportion of the profits as a dividend to shareholders. Any amount not distributed is taken to reinvested in the business. That is called as the return earnings that we have learned in the last session. The current year profit as well as the return earnings of a previous year are available for distribution. A corporation is usually prohibited from paying a dividend out of its capital. A dividend a dividend received by a shareholder is the income of the shareholder and may be subject to income tax. The dividend policy, introduction to dividend policy. The dividend policy of a firm determines what proportion of earnings is paid to the shareholders by way of dividends and what portion is plugged back in the firm for reinvestment purpose, that is called a return earnings. If a firm's capital budgeting decision is independent of its dividend policy, a higher dividend payment will call for a greater dependence on external financing. Thus, the dividend policy has a bearing on the choice of financing. On the other hand, firm's capital budgeting decision is dependent on its dividend decisions. A higher dividend payment will cause shrinkage of its capital budget and vice versa. In such case, the dividend policy has a bearing on the capital budgeting decision. A dividend policy refers to the policy that the management formulates in regard to earning for distribution as dividend among shareholders. It is not merely concerned with the dividends to be paid in 1 year, but is concerned with the continuous course of action to be followed over a period of several years. So factors affecting dividend policy: ownership consideration, the firm oriented consideration, nature of business. Yes, nature of business also affects the dividend policy. Attitude and objective of management. The management decision is also important while forming the policy, right? They might they might allow to give or pay the proportion of their profit as a dividend, or they might reinvest their amount, that is a returning earning. Composition of shareholding, the investment opportunities, they might look for other business opportunities where they will look for more profit. Desire for financial solvency and liquidity, right? If they have future plan, or they have a debt, they might use that profit to pay their debt. So regularity, restriction by financial institutions, that is also affects for forming dividend policy. Inflation, other factors, age of the company, the demand for the capital expenditure, money supply and tradition. Goals of dividend policy. So dividend policy should be analyzed in terms of its effect on the value of the company. Investment by the company in a new profitable opportunities creates value, and when a company forgoes an attractive investment, shareholders in occurrence opportunity loss. So dividend, investment and financing decisions are interdependent and there is often no trade-off. So dividend decisions should not be traded as a short-term residual decisions. Workable compromises is to treat dividends as a long-run residual to avoid undesirable variations in payout. So this needs financial planning over a fairly long-term horizon. Dividend policy should be communicated clearly to investors who may then take their decision in terms of their own preference needs. Erratic and frequent changes in dividends should be avoided. So these are the goals of dividend policy. So types of dividend policy on the basis of company general perspective, that is when it's the perspective with the company management, on the basis of a research study, on the basis of stability of dividend. So on the basis of company general perspective, whether the dividend should be paid right from the initial year or operation, that is a regular dividends. So whether equal amount or fixed percentage of dividends to be paid every year is irrespective of the quantum of earnings as in case of preference shares, that is a stable dividends. So in preference shares, so the rate of dividend returns is fixed. Whether a fixed percentage of a total earning to be paid as a dividend, which would mean varying amount of dividend per share every year, depending on the quantum of earnings and the number of ordinary shares in the year. That is called as a fixed payout ratio. Whether the dividends to be paid in a cash or in the form of shares of other companies held by it, or by converting retained earnings into bonus shares, that is called a property dividend or a bonus share dividend. On the basis of research study, on the basis of the nature of the industry, such as whether industry belongs to the electrical, chemical, fertilizer, or FMCS, or automobiles, pharmaceuticals, textiles, a research study classified dividend policy into three types. There are general dividend policy, more or less fixed dividend policy, and third is erratic dividend policy. On the basis of the stability of dividend, stable dividend per share, stable percentage of net earnings, stable rupees dividend plus extra dividend, and dividends as a fixed percentage of market value. So on the basis of stability of dividends, stable dividends means the rate of the dividend is a fixed and you will receive at the every month. That is called as a stable dividend. So you will receive stable dividend per share, stable percentage is fixed, right? Stable rupees dividend per, plus extra dividend also you will receive is company is offering, and dividend as I told you, dividends as a fixed percentage of a market value, that is a per share. Advantage: the payment of dividends to the shareholders is ensured irrespective of earnings of the company. So whatever company will earn or they will not earn, but the company has to be paid dividends. It is beneficial to those investors who expect regulatory in the income on their investment to meet their expenses, right? So disadvantage: adverse effect on the financial stability of the firms cannot be considered easily by changing its stable dividend policy. Right? In the stable policy, if company is facing more losses, they can't change the policy. Right? They can't consider loss. So that means they have to pay the dividends. They have to face more losses. If the company fails to pay dividend constantly in any year, that shows that weakness of the company in maintaining stability. This is the These are the disadvantages of the stable dividend policy. Forms of dividend. So dividend ordinarily is a distribution of profits earned by a joint stock company among its shareholders. So mostly dividends are paid in cash, but there are also other forms such as scrip dividends, debenture dividends, stock dividends, and in unusual circumstances, property dividends. These are briefly described below. So here are the dividends types. Scrip dividend, bond dividends. So bond dividends are offered as a bond, as a scrip, dividends offered as a property, that is the irradical dividend, cash dividend, the debenture dividend, you will receive a debenture certificate, bonus shares or stock dividends, where you will receive a 2:1 or 1:1 stock if you are holding 100 stock for any stock and company is offered bonus 1:1, that time you will get the 100 shares. So cash dividends means you will receive the cash which company has announced, or they have declared the amount, that amount you will receive in your account. And share bonus means what, like if companies offer 1:2 shares, that means if you are holding 100 shares, at that time you will receive 50 shares as a bonus. So it's like a bonus shares only. So reason for issuing bonus shares: the bonus issues tends to bring the market price per share within a more reasonable range. It increases the number of outstanding shares, and this promotes more active trading. The nominal rate of dividend trends to decline. This may dispel the impression of profiteering. Share capital base increases, and the company may achieve a more spectacular size in the eyes of the investing company. Shareholders regard a business issues as a strong indication that the prospects of the company have brightened and they can reasonably look for an increase in total dividend. Bonus shares improves the prospect of raising additional funds. So this is all about the dividend policies and their determinants. Thank you. Best wishes.